I know the markets are extremely nervous right now, mostly having to do with liquidity drying up, but we think that they will clear up within the next month.
In light of the recent market decline and liquidity challenges, Cathie Wood, CEO of ARK Invest, notes in her analysis that the current strain primarily stems from short-term factors like the liquidity drain caused by technical maneuvers from the Treasury and the Federal Reserve. She predicts the issue will subside within a month.
Are extremely nervous right now. The equity market and the crypto markets especially. And we think we understand why, and we also think this too will pass, because there are some very short-term reasons, mostly having to do with liquidity drying up. Again, very short-term, associated with Treasury and Fed balance sheet, or the Treasury general account and the Fed balance sheet primarily. And so we'll go into that in a minute. But we think that they will clear up within the next month. We have, first of all, quantitative tightening ending on, I believe it's December 1st. Now, many observers expected the Fed to end quantitative tightening with its last meeting. It did not. That was a little unsettling to the markets. And we're hearing from various Fed officials that there is more fear that inflation will not continue to unwind. We have a very strong view to the contrary, but the burden of proof is on us. The indicators have been sticky. Tariffs are one of the reasons, even though business has absorbed, we think, at least half of the shock from tariffs. So quantitative tightening, we think, will end December 1st. That's a de facto easing. And then the various liquidity tightening moves have to do with the Fed reducing its reserves. We're now down to 6.6 trillion. And at the peak, I think we were close to 9 trillion. The Treasury general account is at 940 billion. Normal over the last 3 years has been 600 billion. So the Treasury, because the government is shut down, is building cash and not releasing it into the system. The Fed has been very concerned about all of the easing and inflationary ramifications coming out of COVID, and they still are there, although they have been easing. Interest rates have been coming down since late last year, haltingly to be sure, but they are coming down. By some measures, and we'll go through the charts, while the Fed is easing, it is still quite restrictive. And so we need to hit that tipping point. And we do think that the next Fed meeting, which I believe is December 10th, will be the next decision, that the Fed will take interest rates down again. Now, I am a little concerned that we seem to have more hawks now building on the Fed. That's a bit of a change. We think that the labor market conditions are going to get worse, especially because at the end of September, I think the federal government let go 150,000 people, if I'm not mistaken. So they will get worse when they are reported, and I think that's going to change the dynamic considerably. So when will they be reported? Well, we need to get the government back to work. And the odds are, or the prediction markets suggest, that will be around November 17th. I did just see that Senator Thune is calling everyone back to work over the weekend on a continuing resolution. So it could be a little sooner than November 17th. But then the funds will be flowing again. So again, this is short term. I don't like what we're hearing from the Fed because I do think that they are missing some deflationary signals.